Hi everybody, this is James Tompkins and welcome to Private and Public Company Valuation in a Mergers and Acquisitions content. But first, a shameless shout out to Kennesaw State University. They have a Mergers and Acquisitions Academy, an excellent program targeted to executives. I have sat in on it and it is a certified program. In any case, I want to start off by saying that this is an advanced topic, and honestly, I'm not trying to put you off from watching this, but it will be frustrating if you do not have the basics of finance. And so I would strongly encourage that you listen to one of my playlists on my Understanding Finance channel, the Corporate Finance Lecture Series, and it will make a lot more sense, this whole lecture. So let me begin by asking, do you think that most M&A activity is in the private or public market? Well, what's the difference between the two? What do I mean by private versus public? Well, public is where company stock is bought and sold on the open market. So, for example, if I wanted to, am I free to buy 100 shares of Apple stock this morning? I am, right? So that would be publicly traded. But on the other hand, there's a whole market out there, and what happens in a marketplace? Stuff is bought and sold, right? When this little piggy went to market, well, the little piggy bought roast beef. Okay, so stuff is bought and sold in the market. And there's a whole private market out there where you have to be solicited or invited on a private basis to invest in the equity of a company that's not publicly traded. So in any case, when it comes to acquiring other companies, do you think that most of the time the acquisitions are of publicly traded companies or privately traded companies? Well, it turns out that the vast majority is private. And so my next question is, well, when it comes to fundamental financial principles, for example, risk and return. With higher risk, hey, I'll take on higher risk, but I have to be bribed with what? Higher required returns. Well, do you think that concept changes depending upon whether you're a public company or private company? I mean, is there any reason why it would be different? Not really, right? And so the first point I want to make is, well, there's no logical reason why the foundational concepts that underlie finance would be different for private versus public companies. And is that relevant, therefore, when it comes to its valuation? Well, it is, right? I mean, are we going to use, do you think, financial principles to value these companies? We are, right? So the point is, or the first point to note is that these principles don't fly out the window for one type of company, i.e. private, and remain with public. The foundational principles are the same. Well, what about liquidity and control issues? And by the way, what do I mean by these things? What do I mean by liquidity? Well, something is liquid, at least in the financial context, when it can be sold or easily convertible into cash at fair market value. In other words, not a fire sale price. So for example, Apple stock. Could I, if I had 100 shares of Apple stock, could I trade it just like that? I could, right? I could get on the internet, I could click some buttons, and boom, it's sold. And when I sold it, would it be at a fire sale price, or would it just be at fair market value? Well, it'd be at fair market value. But what about a private company? If I were a private equity investor, so if I owned shares in a company that did not trade publicly, then do you think it would be easier or harder for me to sell it versus a publicly traded company? Well, it'd be more difficult, right? And therefore, when I did sell it, do you think that I would necessarily get fair market value, or I would have to, in a sense, bribe somebody with a lower price, i.e. sell it at a lower price to get them to hold something that is not easy to sell at fair market value. I'd have to provide presumably some type of liquidity discount, right? And so the issue of liquidity or liquidity discount, is that more likely going to apply to a public or private company? Well, more likely a private, but could it also conceptually apply to a public company? It could, right? For example, we have publicly traded stocks, we call them pink sheets, but they're very thinly traded, which means they're not very liquid, which means that when they are bought and sold, well, there's some kind of liquidity discount that would be applied. Now, what about control issues? What do you think I mean by control issues? Well, let's say you completely own a company. You personally own the whole company. What do you control? Do you control its strategic direction? Sure. Do you control who you want to place as CEO and upper management? Sure. Do you even control, how much you decide to borrow on it? Or maybe other types of financing arrangements. You do, right? And so the bottom line is that when a company buys another company, are they also, if they buy it in its totality, are they also buying control of that company? They are, right? But in what circumstance do you think that a company is going to be more, if you will, wholly owned by just a few people? Or even 60% owned by just a few people, by just a few entities? Maybe maybe you have 2 or 3 family members and they start this company and it gets big and it's still private or whatever, and they own 60%. So if they were going to sell their 60%, would you think that you'd have to pay them a premium for also now taking control of the corporation? You might, right? So we'll talk more about that stuff. But my question is, under what circumstance are there more likely to be control issues? In other words, a big block of shares held by just a few entities? Well, probably private companies. But again, control issues conceptually, could they also be applied to public companies? They could, right? So private companies, they're more likely to have liquidity and control issues, but the concepts apply to both. So let me ask you this. When it comes to valuing private companies, is public company information relevant or irrelevant? Well, we're going to find out today it is relevant. Okay? In fact, one of the ways that we will look at valuing a private company, we will be drawing and relying on information that is out there for public companies in similar industries. So let me get into the big picture agenda then of what I want to do today. And what I want to do is I want to begin with a very recent public company announcement. In this case, it's a company that in September announced, this is Media General, announced that, hey, we're going to buy Meredith. And by looking at that article, I want to set some themes that are relevant to both private and public company mergers and acquisitions. The first one is we're going to highlight that, hey, guess what? When it comes to an acquiring firm wanting to buy a target firm, there's a logical floor and ceiling price. In other words, an upper and lower price. We're going to look at also energies related to synergies, liquidity, and control. And we'll talk more about synergies, but really quickly, what do you think I mean by synergies? Well, imagine Coke decides to buy, I don't know, Gatorade. Maybe they already own Gatorade, I don't know. But let's say they decide to buy Gatorade, okay? Well, in places where Coke already sells Coke, Would it be a synergy to say, hey, while we're selling Coke, we'll also just at the same time sell Gatorade? It would be, right? Presumably it would be. So there would be distribution synergies, if you will, in that situation. And then finally, as we look at this article, we're going to look at, well, how important is the process and the diligence of going through a sound valuation analysis? How relevant is that to ultimately the M&A being quote-unquote a success? So let's begin to look at the public company data to value a target company, and then we'll apply this logic to private companies. So here's the announcement. Okay, on September the 8th, this was in the Wall Street Journal, and so this is after the announcement had been made. I think this is the first business day that where it was in the Wall Street Journal. I think the announcement was actually September 4th. But here it is. Media General buys Meredith Corporation for $2.4 billion in cash and stock. Okay, so like I said, we'll introduce some big picture concepts that come out of this article. And if you have access to the article, so if you're able to Google the Wall Street Journal and type it in or whatever, go ahead and read it. And otherwise, I'll hit the highlights. I do not have, obviously, the copyright permission to put the article on YouTube. So here's one of the things it says. Media said it agreed to buy Meredith Corp. So here's the acquirer, MG Media, and here's the target for about $2.4 billion in cash and stock. So here's my first question. What exactly is Media buying? Are they buying the whole thing, which we call enterprise value? Are they also assuming the debt? Well, this puts it in context, okay? Basically, they're putting up this much to take ownership of the whole thing. But when they take ownership of the whole thing, does that mean they're also assuming the debt? It does, right? So the article says, hey, including debt, the deal is valued at 3.1, and you can see that this adds to 3.1 billion. By the way, they're both publicly traded companies, but would this same concept also apply if Meredith had been a private company? It would, right? So the first question I want to ask, and this gets at the concept of, well, what's the minimum price that Meredith would be willing to Media General would be willing to pay for Meredith. And so what do you think? What would be a logical minimum price? Well, let me ask you this. Imagine that I have something in my hand, $1. What's the minimum price that I'd be willing to sell this for? Well, what is it worth to me? Well, it's worth $1, right? So would I be willing to accept anything less than $1 for it? I wouldn't, right? And so presumably the minimum price at which Meredith would be willing to sell itself to another entity, in this case Media General, would be what Meredith is worth to Meredith. In other words, what is Meredith worth on a standalone basis? So if we look at another quote in this article, it says that prior to the announcement, because do we want to use information after the announcement or prior to the announcement? Well, presumably prior to the announcement, right? Because once it's announced, is the market going to look at Meredith in a different way? It is, right? Presumably the market's going to say, hey, now we're going to value you in a way according to our expectations of what you're worth in the hands of Media General, which includes the probability that the acquisition will actually happen. So if we want to look at what Meredith is worth on a standalone basis, in other words, without that information, we would want to look, this is Friday's close, that's September 4th. We would want to look at, what one basis would be its market value. Okay, so it says that before the announcement it was worth 1.4. Let's see, Media General's 1.4 billion. Meredith is 2.1 billion. And so could this 2.1 billion value, remember Meredith is the target, could this 2.1 billion value, could that be a proxy, if you will, for the standalone value of Meredith? It could, right? And so would Meredith logically be willing to accept anything less? Is this like the floor price? I mean, would they say, yeah, you can buy us for 1.5 billion? Well, they wouldn't, right? That wouldn't make logical sense. I mean, very rarely there are situations where the floor price is actually less than what it's valued at, but that might be something like the government requiring a company to spin something off for antitrust reasons, and so they're forced to sell at something less than it's worth. But other than the exception, this would be a logical floor at which Meredith would be willing to sell itself. But what about the upper part, right? I mean, Media General, basically the article said, hey, we'll pay 2.4 billion. So Meredith was worth 2.1 on a standalone basis, and Media General comes and says, hey, we'll pay 2.4. Why would Media General be willing to pay 300 million extra? Well, would it make sense that Meredith, or the upper limit of what Meredith would be, the upper limit of what Media General would be willing to pay would be what Meredith is worth in the hands of Media General? Presumably, right? I mean, presumably, whereas Meredith is worth 2.1 to them on a standalone basis, presumably Meredith in the hands of Media General is worth at least 2.4 billion to Media General. So the next question is, well, what creates this value? What do you think? Why would Media General be willing to do that? Well, what about the synergies that we talked about? Okay, maybe there are synergies, and we'll get into more detail about types of synergies in a little bit, but maybe there are synergies where perhaps Media General can now boost the revenues if they have Meredith, or reduce their costs, etc., etc. In fact, somewhere in the article it says the company said they expect $80 million in synergies within the first 2 years. Well, how much are they paying extra here? It's 2.1 versus 2.4. That's an extra 300 million, right? So how is that justified when we're talking about 80 million in synergies? Well, remember the quote said about 80 million in just the first 2 years, right? And so what do you think's relevant? I mean, if here we have just made up these numbers, say 35 year 1, 45 year 2, so that's 80 million. Would you expect there to be more synergies down the road? You would, right? And when are they making the offer? They're making it today, right? So if I brought all of these back using time value money principles, if I brought all these back to time zero and said, hey, this is the equivalent of what these synergies are worth today, would that be the relevant number as far as what Media General is willing to pay, at least in context with the synergies? Presumably, right? So what's relevant is the present value of all these synergies. Bring all of these guys back to time zero and you get this guy, and that would be the relevant synergy number. Well, let me ask you this. These synergies here, this 35 and this 45, etc., are these guaranteed cash flows or merely expected cash flows? Expected, right? I mean, they're not guaranteed. Presumably they're based on estimates and there's uncertainty, etc., etc. So here I have a bunch of expected cash flows. What else would I need to figure out what all these expected cash flows are worth today? Well, I'd need a discount rate, right? And what characteristic of these expected cash flows does the discount rate represent? Risk, right? I mean, this is consistent with the time value of money model, where the two things that you need are cash flows and a discount rate. So, for example, I could have an expected cash flow in both cases of $35, but for the same expected cash flow, maybe I get a little bit more than expected, like right here, or a little bit less than expected, or maybe a whole bunch more, a whole bunch less. So we have the same, it's possible to have the same expected cash flow, but do those have different elements of risk? They do, right? And which one would require a higher discount rate? The higher risk one or the lower risk one? Well, the higher risk one. So if we value this, just as a quick and dirty example, imagine the discount rate that reflected the riskiness inherent in this first $35 was 10%. Then to value it, I would need a discount rate. So that would be the equivalent of $31.82 today. And again, as I mentioned earlier, I'm going to be building on a lot of concepts already in finance. So for example, on that playlist, there are 2 time value of money lectures. And so if this doesn't make sense to you, then you might want to take a look at that. So let's discuss the synergies a little bit more. So can you think of any examples when one company acquires another company? Can you think of any examples of synergies? Well, for example, what if they each have a headquarter? Would you necessarily need both headquarters? Well, maybe you do, maybe you don't, but it's a possible example. And when you think of some of these examples of synergies, is it fair to say that maybe some of them are one-time events, where some of them go on every year, maybe for 2 or 3 years, and maybe some of them go on forever, potentially? It's possible, right? If we were going to classify some of these synergies, we might come up with revenue synergies, cost reduction synergies, asset reduction synergies. So for example, selling a headquarter, that would be an asset reduction. Revenue synergies, that would mean, hey, you know what? Getting back to my Coke and Gatorade example, well, maybe Gatorade just by itself can sell $1 billion worth of Gatorade, but with Coke, maybe it's $1.5 billion. Why? Because Coke is able to sell more of Gatorade when it's also supplied with Coke. I mean, I'm just making this stuff up, but that's just an example. Or cost reduction synergies. Well, instead of Meredith needing a salesperson and Coke needing a salesperson separately to sell this stuff, now maybe they only need one salesperson to sell this stuff in the same amount of time or with the similar costs. So those are different, broad, different examples of synergies. So let me ask you this: with these different types of synergies, would they have, do you think, identical risks or different risks? Is there any reason to believe they would have identical risks? Presumably not, right? And just to illustrate, give you the flavor of what's relevant with the discount rate, I mean, we already said earlier that the discount rate reflects what characteristic of these expected cash flows? Risk, right? Well, suppose that when Media General said, all right, well, we're going to buy Meredith, suppose they both had a headquarter. And suppose that they knew they were going to be able to sell one of the headquarters, but it would take about a year to sell it. Okay? But there was, and I'm just, again, just illustrating, imagine that the expected sale price and the time of the sale was certainty. Maybe they already have a contract in place, okay? What would be the discount rate if, hypothetically, it was certainty, there was no risk? Well, presumably the risk-free rate, right? And so, closest thing in real life to the risk-free rate might, in this country, say, be a US T-bill, a US Treasury bill. That's where the US government does the borrowing, which by assumption, if we're calling that risk-free, that would mean we're assuming the government will or will not default, or what is the probability of the US government defaulting if we assume it's a risk-free rate? Be zero, right? Okay, so that's a little bit about Synergies. Now, and we've already discussed a lower price. So, for example, what was the logical lower price at which Meredith would be willing to say, all right, you can buy me, but it's got to be for at least how much? That was their standalone value, right? That was the $2.1 billion. Well, what about the upper price? In the end, we saw that Media General said they'd pay $2.4 billion. So that was a $300 million premium. Might they have paid more? Well, they might have, right? That's not necessarily the price ceiling, but presumably that is at least what it was worth in the hands of Media General, or they wouldn't have paid that much. So if we summarize things to date, what would be, in principle, the maximum that Media General would have paid for Meredith? Well, we already saw the minimum was the value of the target, in other words, the value of Meredith on a standalone basis. And what else have we discussed that's been relevant as far as value to Media General is concerned? Well, the synergies, right? So in this case, they paid $300 million above a proxy for the standalone basis. And so presumably, at least logically, with respect to what we discussed so far, Media General is saying, hey, we can presumably get at least $300 million in synergies out of this deal. So let me make a quick point first, okay? Concepts that we've discussed so far, financial principles, we've talked about risk, we've talked about expected cash flows, we've talked about a floor price in the M&A context, we've talked about an upper price. Do any of those concepts that we've discussed so far, do they only apply to public companies or only private companies, or would it be fair to say that they apply to both? Yeah, presumably they'd apply to both, right? There's nothing we've discussed so far where we couldn't say, hey, these things apply to both. Well, let me bring up another point, okay? Is there anything in the article, if you've had access to it, that suggests, hey, maybe Media General paid too much for Meredith? Well, if I pull out a quote from the article, it says, in Tuesday trading, this is the first day of trading after the announcement, Media General, so this is the acquirer, fell 6%, whereas Meredith shares leaped almost 10%. So at least with respect to the markets reacting, is that like the market saying, hey, Media General, you paid too much, or you paid about the right price? What do you think? Well, presumably the market is saying, well, hey, we're going to punish your shares by 6%. Presumably they feel like there's some kind of overpayment. And by the way, that's on average a pretty typical reaction. Typically, the target shareholders benefit. So we saw Meredith went up about 10%, and the acquiring firm, they may have a loss, or they may gain nothing. And so the question is, well, what are some reasons for this apparent overpayment? Well, what about, for example, I'll just make something up. The value of the synergies. What two things did we need to value the synergies? Well, we needed cash flows and a discount rate, right? And would that include a forecast, therefore? Are we valuing future synergies or past synergies? And in fact, were there any synergies in the past? There weren't, right? Because they weren't together. So in other words, we're talking about forecasts. Yeah, we're forecasting cash flows. We're trying to estimate a discount rate. And so maybe the forecasts are optimistic. And there are other reasons too that are cited. So for example, hubris. Yeah, hubris is a word that relates to ego. So for example, you might have a CEO and he or she might say, yeah, I can acquire this firm, and yeah, no problem. We can pay this much and it'll create tremendous value to our company, and maybe they're overconfident. Maybe the decision-making process was poor. Maybe they didn't do enough diligence, and so on and so forth. Or maybe the market's wrong. Maybe the market's not efficient. Maybe the 6% punishing of Media General is a negative overreaction. And that would be consistent with the markets not being efficient and not efficiently pricing Media General once it had announced it would acquire Meredith. And we could probably come up with some other reasons. But in any case, as we sort of tie this all together, what do you think? What should the buy-sell decision rule be for the target and the buyer? In other words, what are our floor and ceiling prices? Well, essentially, the acquirer should buy if what they pay for it is less than the intrinsic value of the target, or the true value, we'll talk about that more in a minute, of the target to the buyer. In other words, in the case of Media General, they paid $2.4 billion. Okay, well, if that amount is less, then maybe they decide the true value of Meredith in their hands is $3 billion, then that's a great deal, right? Hey, we paid 2.4 for something that was worth 3. And under what circumstances should the target sell? Well, in the case of Meredith, they received 2.4 billion, but what if the intrinsic value, or the quote-unquote true value to Meredith on a standalone basis was only 2.1? Well, that'd be a great deal, right? So, the next question then is, what is intrinsic value? Well, guess what? Warren Buffett basically says it's discounted cash flows. He says, and this is from his owner's manual, 1996, you can Google it if you like. He says, intrinsic value is an all-important concept that offers the only logical approach to evaluating the relative attractiveness of investments and businesses. Intrinsic value can be defined simply as the discounted value of the cash that can be taken out of a business during its remaining life. Well, all right, so this is one type of value, but apart from other discounted cash flows, are there any other types of value that exist out there? Well, sure. I mean, there's things like book value and replacement value, market value. There are trading multiples, transaction multiples. We could probably come up with others. And some of these are arguably going to be relevant, and others not that relevant. For example, book value. What is book value? Is book value old news or current news? Well, it's old news, right? I mean, unless you buy something right now, then book is the same as market. But otherwise, if I bought a piece of property 10 years ago, its book value is essentially what I paid for it 10 years ago. I mean, I know I'm hand-waving over depreciation and that kind of thing, but But when you make decisions, here's the big picture. When you make decisions about acquiring targets and so forth, do you care about old news or new news? Well, new news, right? Current valuations. Replacement value, well, that's probably not that relevant. I mean, is Media General looking at replacing the various assets in Meredith and comparing what it would cost to actually physically replace the assets versus acquiring Meredith and all its customers and so on and so forth? Market value, that's not a bad proxy. It's being traded, publicly traded. But why would market value, for example, be different from intrinsic value? Well, what two things do you need for intrinsic value? We'll talk about this in more detail, but cash flows and a discount rate, right? And so why might Meredith value itself differently than the market? Well, does Meredith have more information about itself? It does, right? Whereas does the market only have public information? It does, right? And then with a lot of valuations, a major approach is trading multiples. In other words, for example, the ratio of the enterprise value to EBITDA, earnings before interest, taxes, depreciation, and amortization, or transaction multiples of peer firms, with actual M&A transactions. What are some of the multiples that have existed recently? And we could probably come up with others, right? So my question is, if, at least according to Warren Buffett, if intrinsic value, in other words, this discounted cash flow stuff, if that's true value, then why bother with all of these other methods? Well, is intrinsic value observable? Am I going to see a ticker tape somewhere of saying, hey, you know what, this is what Meredith is trading for right now, but here's its true value, or here's its intrinsic value? And you're not, right? And so would it be fair to say that, well, all right, well, the less confidence that I have in the discounted cash flow, because remember, what two things do we need? We need expected cash flow, so that's a forecast, and we need a discount rate. And we're going to get into estimating all those things, but there's going to be some estimation involved, right? And if I don't have a lot of confidence in that, does it make sense to, in a way, or in a sense, triangulate with other types of valuation approaches? Presumably it does, right? And so, a very common part of valuation is going to involve not just this approach, but also other approaches. And it just makes the whole valuation process potentially richer. Not necessarily. I had one private valuation person say to me, one time, you know what, this discounted cash flow stuff, it's fiction. And yet Warren Buffett is saying, no, you know what, you need to do this. And so, I recognize and appreciate there are different camps out there. And obviously we'll be covering both. So what we have so far is that, an upper price to, in this case, Media General is going to be, hey, what's this company worth on a standalone basis, plus the synergies? And I want to add a couple more concepts now, okay? So let's assume that this guy right here, the value of the target, or Meredith, on a standalone basis, let's assume there are no block holders. And what do I mean by a block holder? Well, essentially that no entity or few entities own a significant percentage of the stock. Okay, so if somebody owned 40% of the stock, they would be like a block holder. So, question, okay, how do you think this formula would change if Meredith were private? In other words, let's assume its shares were not liquid. Okay, so here we have a company where there are no block holders, so ownership is widely dispersed, but it's private and it's not liquid. Okay, then do you think that Media General, do you think the acquiring firm could say, hey, you know what? Compared to what you would be worth if you were liquid, you're actually worth less, i.e. this guy, because you're not liquid. Would that be reasonable or unreasonable? Presumably reasonable, right? I mean, even Meredith would know, you know what, we're not going to be able to sell our shares if we were private and we were illiquid for the same amount relative to being publicly traded. And so presumably Media General could demand a liquidity discount. So again, if we call this guy here what it's worth as if it's completely liquid and there's no block holders, we could say, well, now the maximum price is going to have to be adjusted by some sort of liquidity discount. So in other words, what we have in here would be the value that Meredith General, the ceiling that Media General would be willing to pay for Meredith. This guy, the benchmark is, hey, this is me, Meredith, what I'm worth on a standalone basis, assuming full liquidity and no block holders, and plus the synergies that Media General believes they can achieve. But then, let's knock off a liquidity discount. So how do you get the liquidity discount? I mean, where does that number come from? How would you do it? Well, basically, there are various studies and databases out there, and history provides a clue. So, for example, there's something called the private company discount based on empirical data. This is a 2013 publication, and it summarizes 4 different studies, and there are discounts in there along the order of 20, 30, 40%. So bottom line is, if you're involved in this, you're going to need to go to or probably buy data from a database or have a professional provide you with current liquidity discounts for your particular situation. All right, so now let's add in another issue that we talked about later. So imagine, again, base case, right? This guy here, this assumes the value completely liquid and no block holders. But now we ask, well, what if we did have a block holder? Okay, what if the acquirer already owned 20%? And the acquirer wanted the remaining 80% or enough to get control of the target. And by the way, would the acquirer need a total of 100% to have control? They wouldn't, right? I mean, it's a matter of voting rights. They might decide, you know what, to get control, maybe we only need 40%. Maybe that gets us enough board members to put on the board where we can have control over the strategic direction and so on and so forth. So 100% is not the magic number. Even 50%, over 50% is not necessarily the magic number to maintain control. But if with 20% they did not have control, and with 80% of course they did, would it make sense that they would have to pay, if you will, a control premium? Do you think it would have value to Media General to have control over, say, the strategic direction of Meredith? Presumably it would, right? And if it did have value, does that mean that they would be willing to pay for it? Presumably it does, right? And so that would or would not be relevant to the ceiling that Media General, the acquirer, would be willing to pay for the target. Well, presumably it would be, right? And let's take a look at the value for a second of this this control premium, or what it's what it's worth. Okay, so let me ask you this: if Media General, the acquirer, were planning on operating Meredith on a business as usual basis, in other words, they're not even looking at any major strategic shifts, then And do you think the control premium would be worth more to them or less? Presumably more, right? If they were going to do a major shift, it would be worth more. If it's a business as usual, it would be worth less. So if we now take another look at the control premium, again, imagine this is completely liquid and this base case, and there are no block holders, and now we say, okay, well, what would happen if the acquirer already owned 80%? For example, Sprint. Okay, Sprint is currently, I forget, I think it's 85% owned by another entity, or maybe it's 80% owned by another entity. In other words, if you're a Sprint shareholder, you're a minority shareholder, which means, have you already given up control, strategic control of Sprint? You have, right? And so therefore, if you're going to sell your remaining shares to this other entity, then and you're not providing them with any incremental control options, then are your shares going to be worth as much? They're not, right? And so this would be an example where if you're not giving up control, then presumably your shares would sell at a discount. Again, just to illustrate that this same concept applies whether you're a private or public company. Google has dual class shares. What that means is that the owners and the founders of Google, they have a class of shares where they have, I forget, I'll make it up, say 10 times the voting rights. So for every share they own, it counts as 10 shares. Whereas you and I, if we own Google, it just counts as 1 vote. And so currently, Google, the shares that are out there trading in the public does not have control. The founders have kept control. And therefore, our shares, relative to the founders' shares, would sell at a premium or a discount. Which one would sell for less if you don't have control? Well, our shares, right? Because we don't have control, so they're not worth as much. So the point is that when it comes to control, either it could be a premium or a discount. If the target is selling enough shares where they're also selling controls, would that be a premium or a discount? That'd be a premium, right? But if the target has already sold off a whole bunch of its shares, maybe 80% or whatever, so they've already lost control, then would that suggest they would have to sell at a premium or a discount? Discount, right? So now if we put it all together, if we now consider the issues of liquidity and control, well, here's kind of the, what we began with. The maximum price that presumably Media General would pay for Meredith would be, hey, what Meredith is based on a standalone basis, assuming that it's completely liquid and consuming there are no block holders and no control issues, plus the present value of any synergies. So, Media General might say, hey, we can sell one of the headquarters. Well, that's worth something today. Hey, forever, we can reduce costs. Well, all of those reduced costs forever. That's worth something today, etc., etc. But then if this were a company that was not liquid, presumably there'd be a liquidity discount involved. And then we've just discussed, is there a change of control going on? And that could either be a control premium or a control discount. And, the control premium and discount, again, it can be very difficult to measure. And guess what? Just like liquidity, guess what we're going to have to rely on? History, right? So let me bring one more thing into context. I want to think about, all right, we're going to go through all of this valuation, and I want to think about, well, how important is it, or how does valuation fit into the whole M&A process? Okay, so there's a Harvard Business Review. It's a 2011 article. It's called The Big Idea, the New M&A Playbook. And in that, they say, you know what? 70 to 90% of M&A deals fail by some measure. And, of course, it depends how you define success, right? Well, how would you define a successful M&A deal? I mean, think about it. What would you personally say? Hey, you know what? If we do this, this is a success. Well, when companies make acquisitions, do you think there's typically just one choice, or they have a number of alternative different strategies at their disposal? Presumably alternative strategies, right? And so maybe one way of defining success is, well, the highest value course of action. So if you engage in quote-unquote quality valuation, does that make it more likely that you'll have a quote-unquote successful deal? Presumably it does, right? But even if you have, the perfect valuation techniques, okay, you've just done everything right. You've done a really great discounted cash flow, and you've compared it to transaction multiples, and you've compared it to various other multiples, and they all seem to line up, etc., etc. Is that necessarily going to result in a successful deal? Well, not necessarily, right? I mean, what if you're not looking at the right opportunity? And what about implementation? So even if you make a great deal at the beginning, what if you don't execute it very well? There are some boards, for example, where they will engage in a big acquisition or whatever, and they will dedicate, at least temporarily, a board committee for merger implementation. And that board, for example, will make sure that there is somebody accountable for a particular area for whatever is important in the implementation, and they'll provide oversight, and they'll make sure there's a plan, etc., etc. And so all I want to do is, yes, we're going to go through evaluation techniques and so on and so forth, but this is just one component of a whole M&A decision. Okay, there are other components that in the end, not guarantee, but will make it more likely that the M&A will be successful. Okay, so at this point, if you want to take a break, now's a good time for a break. I sort of think of this as part 2. So far, we've set some themes. We've said, all right, hey, financial principles, fundamentals like risk and return, they apply to just public companies, or private, or both? They apply to both, right? And we said, you know what? All right, fine. There are some issues that are much more likely to happen in the private market. For example, what? Well, liquidity issues, control, premium, or discount issues. Then we've also said, okay, we've set some themes with the floor price and the maximum price. So, for example, what would be the minimum price that a target would accept? Well, presumably their standalone value, right? And what would be the maximum that an acquirer would be willing to pay? Well, presumably what the company or the target is worth in the hands of the acquirer. So what we're going to get into now is the actual valuation. And what we'll do is we'll use public company data to value the target on a standalone basis, assuming no liquidity or control issues. And again, why are we interested in this? Well, presumably this is the logical minimum or floor price, right, that the acquirer would be, or that the target would be willing to accept. And then the acquirer has to decide on whatever premium they're going to need to bribe or incentivize, if you will, the target into being willing to say, all right, sure, go ahead, acquire me. And what we'll do is we'll go through valuation principles, and we'll begin with public company information, and then we'll apply it also to private company. So if we look at maybe a more specific agenda, we said that at least what did Warren Buffett refer to as intrinsic value? He talked about discounted cash flow, right? And what two things do you need to value anything with the discounted cash flow approach? Well, you need cash flows and a discount rate, right? So we're going to begin by estimating the cash flows of the target, and we're going to find out that free cash flows are what's relevant, and we'll talk about what that is. Then we'll say, all right, well, given that, then what's the standalone value where we assume the discount rate? And then we'll figure out, well, what should the discount rate be? So let's begin with the cash flows. Okay, so I've already said that free cash flows is going to be the relevant set of cash flows to value the target. So what are free cash flows? Well, this is a definition, right? And do you understand definitions, or do you memorize them? Well, definitions you memorize. Everything else you should understand. So for example, I've memorized the sky is called the sky. I don't know why the sky is called the sky. So what are free cash flows? Well, basically, they're cash flows available to the investors after the company has spent any money it's needed for capital expenditures. In other words, capital expenditures to keep the company going and to fulfill the growth prospects. So we'll start off by estimating, well, what are these free cash flows? How do we get these? And we'll stick with Meredith. Okay, we'll do it. We'll see what Meredith should be worth on a standalone basis. And so we're saying, all right, well, here's Meredith's standalone value, okay, and here are all the free cash flows. Well, if I had a discount rate, could I apply to these free cash flows the discount rate and then get a single number right here? I could, right? And so the question is, after accounting for any capital expenditures, what cash is the target expected to generate to which investors have a claim? And here are the investors, in this case, the debt and the equity holders. So obviously, a simple place to start is, all right, well, here I have my lemonade stand, and with my lemonade stand, what am I hoping to do? Well, presumably sell lemonade, and I have to pay for the lemons, etc., and I end up with profit. So this is just a simple income statement. Well, we're not doing this for a lemonade stand, we're doing this for Meredith. So presumably, this is a good place to start for estimating free cash flow. And to keep it simple, just for now, I'm going to assume that Meredith's most recent year of past performance is an estimate of future performance. And so I'll begin with, if we start with the income statement, what kind of adjustments do we need to go from an income statement to Meredith or the target's free cash flow? So here are Meredith's actual public filings of its most historic performance. Notice that year end is June 30th, 2015. The announcement was the first business day after September 4th of 2015. So to keep it simple, I'm just going to assume that in June and September are more or less the same time period. Obviously, you could make an adjustment for those 3 months. So let me clean up this income statement a bit. Okay, so I've just condensed some of the items. So here we have Meredith, its most recent income statement. It's here are the revenues, and here's the profits, and so the first thing to ask you is, all right, well, we're trying to determine cash flows generated by Meredith's operations that are available to the investors. So should I be talking about profits or cash flows? I mean, here's the profit number, right? Should I be using a profit number or cash? Well, let me ask you this. If I had the 3 top accounting experts in the world come in and try to figure out Meredith's profits for the last year, how many different answers do you think I'd get? probably get 3 different answers, right? I mean, not because they're doing anything wrong, but because in accounting is their judgment and so on and so forth, like different accounting techniques and etc. There are, right? But on the other hand, if I had this dollar bill right here, is there anybody who'd be willing to pay me, say, $1.01 for this dollar? Presumably not, right? Is there anybody who'd be willing to sell this dollar for, say, 99 cents? Presumably not, right? So is there any argument about what this is worth at this point in time? There's not, right? This is worth $1. There's no debate. So therefore, in finance, what do we care about? Profits, which are subject to judgment and different rules and so on and so forth, or cash flows? Cash flows, right? And what about interest? Notice that to get to profits here, I'm subtracting interest. Should I deduct interest? Well, the answer is no, because what we're trying to figure out is, what is Meredith as a whole worth to both of its investors? Meredith is a set of operations, right? I mean, if I draw Meredith, we have Meredith's assets, and we have its debt, and we have its equity. Okay, so here are Meredith's operations. This is the guy that we're trying to value, right? Which looking at Meredith's enterprise value. And so what this generates is available to both of these guys. So if I already subtract interest, in a way, would that be like double counting? It would, right? So then you're going to ask, well, hang on. I mean, you're paying the debt holders money, right? Isn't that relevant? Well, yeah, of course it's relevant. But what about the equity holders? Do they also require some kind of return, or do they just provide their money for free? Well, no, they also provide a return. And so it turns out, and this will become obvious later as we continue to look at this valuation, it turns out that both the cost of debt and the cost of equity is incorporated in the discount rate. So we don't want to double count, so we're not going to subtract interest. What about this? Do we want to look at before tax cash flows or after tax cash flows? Well, if you look at it on a before tax basis, does that mean, like, let's say that a particular before tax cash flow is $100 and $30 belongs to the government? Well, when you're valuing something, do you care what you get in the end, or do you want to mix up what belongs to other entities, in this case the government? Presumably what it's worth to you, right? So you want to pay everybody off. In our context, if we're looking at free cash flows, we want everybody paid off except what its value is to the debt holders and equity holders. So the workers should have been paid. In other words, we're going to subtract cost of goods sold and et cetera, et cetera. So we want this on an after-tax basis. So if we begin with this as a starting point, what adjustments would we make to get free cash flow? And I do want to add in one little caveat here. I am not an accounting expert, and I am not suggesting that we go through is going to make you an expert in this. Maybe I'm just giving you enough information to know the right questions to ask. But you could take a whole accounting class and get into all the nuances, for example, deferred taxes, etc. So what I'm going to be doing here is primarily big picture. So having said that, imagine this is, don't imagine, these are the actual numbers, Meredith's actual numbers for their most recent fiscal year end, which was June 2015. So first of all of these guys, okay, all the way down to earnings before interest and taxes, are those dollars produced by Meredith's operations? They are, right? So would they be relevant to free cash flow? They would, right? I mean, presumably these are dollars that both the debt holders and the equity holders have a claim on. So what do I have to subtract at this point? Well, will I subtract interest? No. No, we care about Meredith's operations, right? We don't want to mix in financing decisions and operational decisions. And besides, we already said that the cost of debt, which is interest, and the cost of equity is incorporated into what? The discount rate, as we'll find out later. Well, so are there any other adjustments we have to make here? Well, do we still owe the government money? We do, right? And so Meredith's tax rate was about 39%, and so our operational after-tax profit would be 150,000 roughly. But the next question is this a cash flow? It's not, right? Why is it not a cash flow? Well, what about this guy, depreciation and amortization? Is Meredith physically forking out depreciation, etc., to somebody in cash? They're not, right? I mean, this is merely deducted because it does or does not have an impact on taxes. It impacts taxes, right? Because we're deducting this, does that mean that this number here is bigger or smaller? It's smaller, right? Which means we're paying more taxes or fewer taxes because of this depreciation. Fewer taxes. We have, depreciation is shielding us from taxes. So we needed this number right here to work with to figure out our taxes, but now what do we need to do to change it into a cash item? Well, we need to add it back in, right? Because that was not a true cash item. So now we have our operational after-tax cash flow. So then here's my question. So are these guys, is that therefore Meredith's standalone free cash flows? So Meredith on a standalone basis, if we assume that the last historic year, which is how we got this 206,000 roughly, if we assume that that is a forecast for future years, are these the free cash flows? Well, no, because if Meredith is going to continue to exist, with respect to what its operations can generate, would you expect it to maybe, maintain machinery and maybe even buy new machinery, et cetera, et cetera? In other words, would you expect it to have future expected capital expenditures as it continues to be an ongoing entity? Well, presumably you would, right? And so when it comes to calculating free cash flows, we still need to incorporate capital expenditures. What about changes in working capital? Well, what is working capital? Well, working capital is current assets minus current liabilities. It's an accounting definition. Current assets includes things like inventory and cash, etc. Current liabilities, maybe you owe some vendors, so maybe you've got accounts payable, etc. So that difference is working capital. So for example, if a grocery store decided to double in size, would it now have more food on the shelves and more cash and more additional tillers? It probably would, right? Which means it would need more working capital or less working capital to have the extra cash in the tillers and extra food on the shelves, which is inventory. It would need more working capital. So its change in working capital, would it increase or decrease when that grocery store grew to double its size? It would increase, right? And would that be a source of cash or a use of cash? Be a use, right? Because you'd need money to pay for the additional food, etc. So when the change in working capital goes up, so you need more of it, that would be a positive or negative cash flow. That would be a negative cash flow. So let's look at the change in working capital first. Okay, so here are the 2014 numbers. So current assets minus current liabilities. Current assets minus current liabilities for 2014 is right here. For 2015, it's negative. Okay, so if we look at this change, this minus that, it's actually minus 58,000. So in other words, working capital has gone down for Meredith in the last year. And so would that be a source or a use of cash? That'd be like a source, right? That'd be the opposite of the grocery store example. It doubled. So does that make sense? Working capital declining for a firm that is expected to be growing if Meredith is expected to be a growing firm? It doesn't, right? So maybe, again, this is why you would need an accounting class to really dig into the weeds. So we're just getting big picture about this, but we're keeping track of our assumptions, and we'll probably challenge this assumption a little bit later, but we'll stick with these numbers. So what about capital expenditures? Okay, so here's total property, plants, and equipment in 2014. Here it is in 2015. So we spent more money, and so we're assuming, this is an assumption, again, I'm not getting into the weeds. In fact, there are other issues going on here that I'm not bringing up. But we'll assume that the change in property, plant, and equipment is the capital expenditures. So if we put it all together, we would have $238,452 in free cash flow. So in other words, we go from our operational after-tax cash flow. So this is on an after-tax basis, the cash that Meredith is expected to produce that belongs to who? The debt holders and the equity holders, right? But then, in this case, this is odd for a growing firm. Working capital has gone down, and of course they've spent money on capital expenditures. So if we assume that this guy right here, this $240,000 roughly, is what is expected in the future, then this would be an estimate of the free cash flows. But do you think that's necessarily going to be the case? Do you think there are going to be assumptions involved? Well, yeah, right? I mean, Meredith has information about what they're worth and about their expectations if they were going to be on a standalone basis. So, for example, they might make assumptions on, well, we expect the percentage of cost of goods sold as a percentage of sales to be, say, X%. So in other words, there are going to be some key assumptions involved in estimating these cash flows. Now, if you recall earlier, we talked about, in the first part of this mergers and acquisitions, we talked about the fact that most M&A's deals, they fail or they succeed. Well, most of them fail, right? And one of the reasons we talked about was because, well, of these forecasts, maybe they're optimistic and so on and so forth. Well, I know somebody who was a CEO of a large U.S. corporation and CFO of a large corporation, and he's been involved in many, many deals, dozens of deals, as I recall. And he just has an amazing and very logical approach to this. He basically would narrow down the key variables in the valuation. Let's just say, for example, that this assumption was really key. And he would bring in whoever had most control over that assumption. And he would say, well, hey, what do you think? You're willing to, you think it's going to be 5% cost of goods sold, a percentage of sales moving forward? And the guy might say, yeah. And he said, well, so if a year from now it's less than that, you'd be willing to lose your job, and if it's more than that, we'll give you a bonus. And then the guy, well, hey, what, I'd lose my job? Well, yeah, this is really important. And then they would maybe look at it more closely and say, well, actually, no, 4%. And so that's one way that he controlled the key assumptions. But of course, the trick is to identify what are those key assumptions, number one. And number two, who has the best control over those assumptions. So in many cases, or all cases probably, what will typically happen is that they'll do a forecast of maybe 3, 4, 5 years or whatever, and then thereafter they'll assume, all right, well, thereafter our growth is going to be 0 or 1% or whatever it is. So here we have, 238,000 roughly. So I'm just rounding. Imagine that in 2016, so a year after the announcement, that Meredith's free cash flows were expected to be 240, then 245, then 250. I've just made up some assumptions, and after that, growth is 0. Okay, and so at this point, if this is what we've decided, or if this is what we believed, or Meredith believed, what their free cash flows were, what else would they need to now say, all right, well, now we know what the enterprise value is of Meredith? Well, you'd need a discount rate, right? We need cash flows and a discount rate. So we have expected cash flows, and now we need a discount rate. So moving forward, what we'll do is we'll just make up a discount rate, and then we'll figure out, well, how do we get this discount rate? So if I just make up a discount rate of 10%, then can I now use time value of money principles? I can, right? And so in this example, it would be, about 2.5 million, or 2.5 billion actually, because it's you got to add some more zeros. This guy right here is called the terminal value. Okay, and if that doesn't make sense to you, then of course you can look at the time value of money lectures. So the terminal value, by the way, is often a key assumption. In other words, that this growth rate, this assumes 0 growth. This represents at time 3 the value of it being 250,000 all the way going on forever, but it's brought to time 3. And it's typically a key assumption. So for example, if I just change the assumption just from 0% growth, in other words, instead of 250,000 forever, to 1% growth, then we would jump up to 2.7 billion. So we changed the growth rate for the terminal value by 1%, but guess what? It made over an 8% difference in the whole valuation of Meredith. So if we go back to the no growth assumptions, who has a claim on this 2.5 billion? Well, investors do, right? Remember what we said? If we look at the cash that Meredith generates that's available to the debt holders and the equity holders, well, notice the debt holders have not been paid. We haven't subtracted interest. The equity holders have not been paid. So this is what everybody's been paid. And we've accounted for plans of keeping this company running, maybe even growing it with additional capital expenditures. And so basically, this 2.5 billion is what is available to the debt holders and the equity holders. So if we wanted to calculate the minimum value that Meredith would be willing to accept for its equity, then what other number do we need? We need the debt, right? Because we have this. That's the 2.5 billion. That's the target enterprise value. Well, if we then have debt, can we then back out equity? We can, right? And if you go to Meredith's balance sheets, here's all their debt. It comes to $795,000. Any criticisms on using the $795,000? Well, is it a market value or a book value? Well, it's a book value. And it's not a bad assumption. Book value is market value for debt, at least relative to equity. It's not a bad assumption if a company is not in financial distress. And maybe later on we'll clean it up a bit and we'll make it a market value. But in the meantime, just to get across the big picture, okay, here we have basically, here are the free cash flows. I've just made up a 10% discount rate, which means this is 2.5 billion. If the debt holders, if the value of the debt is $795,000, then we've just calculated the minimum amount that Meredith is worth. So let's compare this to the article. According to the article, do you remember what Meredith was trading at, or what its equity value was before the announcement? Well, it was 2.1 billion, right? And what we got just now is only 1.7 billion. Why the big difference? Well, we've made estimates, right? I mean, I just made up the estimates. Okay, well, first of all, discount rate was completely made up, and the cash flows, I just said, well, assume no growth, or, et cetera, et cetera. In fact, if I wanted to, I could just change a few assumptions and make the estimate close to 2.1 billion. And so, does that highlight the importance of doing sensitivity analysis? What is sensitivity analysis? Well, basically, when I changed the growth rate from 0% to 1%, that was sensitivity analysis. And so, are there some assumptions that are going to make a huge difference to its value, and some assumptions that are going to make hardly any difference? There are, right? And those assumptions that make a big difference, are you going to want to spend more time, energy, and money in trying to figure out what the estimate should be? Presumably you are, right? Another reason you could argue for the big difference is maybe the market's wrong. And obviously that depends on your views of market efficiency. So just to illustrate, assumptions, notice that sales, for example, between 2014 and 2015 changed by 9%, but the previous year by only 0%. So if we made just a modest change to the assumptions, so for example, remember we began with 238,452, that was our historic free cash flow. If we assumed that this grew at 5% for 3 years, so that's grown at 5%, another 5%, another 5%, and after that the growth rate was 3%. Well, if we applied time value of money stuff, now it would come to 3.7 billion. So 3.7 billion, subtract the value of the debt, now we're up to 2.9 billion. So again, it highlights the importance of this sensitivity analysis. And by the way, it also explains why some people that are in the business of buying and selling companies, at least when it comes to private company valuation and public even public company valuation, they may say, you know what, this is fiction, but there's going to be a spectrum, right? Warren Buffett, no, you need to do this. Others, this is fiction. So that basically covers cash flows. Again, from a real big picture perspective, okay, you would need to dive into the weeds with much more depth of accounting to get out some of the nuances. And at this point, I made up a discount rate. So now what I want to do is get into, well, how do we get this discount rate? And again, this might be a good time for you to take a break. So this is another big section. So as I mentioned, I hate to keep bringing this up, but it's just going to be frustrating to you otherwise. I already have on YouTube where these formula comes from, and it's important to understand the whys as opposed to, all right, well, here's a formula, plug and chug. By the way, why is that important? Why is it important to understand the application of the formula as opposed to, well, here it is, I can just plug and chug it? Well, because the formula is basically a product of theory, and unless you understand it, you have no chance of using judgment in translating that theory into practice. So in this case, the formula that provides us the discount rate for the target, we're valuing the target, so we want a discount rate for the target, is the weighted average cost of capital of the target. And so, if you want more detail about that, well, it's right there. It's the discount rate for the asset investment decision on the channel. But guess what? The weighted average cost of capital has inputs: required rates of return of debt and equity. And again, if it's important to understand the logic. And so the discount rate for financial securities, in fact, you'd want to watch this one first, and then the discount rate for the asset investment decision. And we'll also need to know for this section issues about beta, levered beta, unlevered beta. And I'm going to be assuming that you have an understanding of what I mean by those. All of those things are going to be relevant to valuing both a public company as well as a private company. So, essentially, from a very big picture perspective, the debt holders, are they going to say, hey, you can have my money for free, or will they require a return? They'll require a return, right? What's another word in the English language for required rate of return of debt? Interest, right? And so under what circumstances would the debt holders say, hey, we require a higher return as opposed to a lower return? Well, they're basically going to say, well, what are you doing with my money? And if I'm taking their money to Vegas, hey, will you lend me some money so I can take it to Vegas? What will happen to the interest rate? Will it go up or go down? It'll go up, right? So this depends upon the risk inherent in the asset. What about the equity holders? Will they say, hey, you can have my money for free, or will they also require a return? Well, they'll also require a return. They'll say, hey, what are you doing with my money? The riskier it is, will they require a higher or lower return? A higher return, right? And what else will they say? Well, who gets paid first? When my lemonade stand or whatever company it is generates cash, who has first claims on that cash? The debt holders or the equity holders? The debt holders, right? So the equity holders are going to also say, hey, what are you doing with my money, and how many folks get paid before me? Or I'm putting that simply, but how many debt holders in terms of dollars are there before me? Because the more there are, does that mean there's more likely or less likely going to be money left over for me as an equity holder? Less likely, right? And if it's less likely there's going to be money left over for me as an equity holder, does that mean it's more risky for me as an equity holder or less risky? More risky, right? So the equity holders are going to say, what are you doing with my money, and how many folks get paid first? The debt holders are going to say, hey, what are you doing with my money? And then based upon these two guys right here, we basically state that, well, the reflection of risk on this side is a reflection of risk on this side. In other words, a weighted average of these guys, but on an after-tax basis, is how you're able to infer the discount rate for the target. Again, I just flew through the details of the whys there. You'd have to go to the full lecture to appreciate that. And also we see a formula here for determining the required rate of return of equity. It's the CAPM formula. And that is also available on YouTube. So these are the inputs. So my question is, well, these concepts that, for example, the overall risk as reflected in the discount rate, and in other words, weighted average on this side should equal that side, are those kind of concepts, required returns and risk, etc., do they apply just to public companies or also private companies? Well, presumably also private companies, right? So what we're going to do is we're going to say, well, all right, well, how do we get these required returns for Meredith, which is a public company? And then building on this knowledge, we'll say, well, how would we have gotten those returns? So required rate of return of debt and the required rate of return of equity, which is needed for the weighted average cost of capital. How would we have gotten those if Meredith had been a private company? So let's dive into that. So if we look at the information provided in for Meredith, okay, from the June 30th, 2015 10K. First of all, we'll just tackle these one at a time. These percentages, equity and debt, what do you think? Do you think we want book value percentages or market value percentages? Well, is book old news or current news compared to market? Well, book is old news, right? And when are we making the decision? Well, we're making it today, right? So what's relevant, book or market? Market, right? And so if we're going to get market values, do we care about, for example, the market value of Meredith's equity before or after the announcement? Remember, we're trying to get what is Meredith worth on a standalone basis. So what's relevant? Well, presumably before the announcement, right? Because after the announcement, is that going to already incorporate any market expectations, which includes Meredith being acquired? It is, right? And so right now we're trying to figure out, well, what is Meredith worth on a standalone basis? So how do we calculate the market value of equity? Well, if I have 10 shares of Apple and Apple is trading at $100 a share, how would I figure out the market value of equity that I own for Apple? Well, presumably it'd be 10 shares times $100 per share, or 1,000, right? And so could you do this for the whole company for Meredith? You could, right? So simply the number of shares that are trading out there multiplied by the stock price. And you know, the number of shares outstanding is available information, again, in the 2015 statements. And before the announcement, the last business day before the announcement was Friday the 4th, and that's the share price. So we have the market value of equity being about 1.8 billion. So if we put this together, okay, remember we've got 1.8 billion. We've assumed market is book for debt. If we add it up, here we have the total value. If we wanted to, we could actually clean this up. Okay, remember I told you for a firm that is not in financial distress, is book value and market value for debt not a bad assumption, at least relative to making the same assumption on equity? It's not a bad assumption. But if you look at their filings, okay, in Meredith's filings, they estimate a quote-unquote fair value of long-term debt, because Meredith doesn't have publicly traded debt. They have private debt. And so they estimate 797. Notice how close that is to the 795. And how do they estimate it? Well, guess what they need? Well, they need cash flows and a discount rate. Are the cash flows going to be that difficult to figure out? Well, if you borrowed money, let's say for your mortgage, let's say you borrowed money for your mortgage, is it pretty easy for you to figure out what you owe and when? It is, right? That's in the contract. And it's the same thing for a company. So for debt, the expected cash flows are pretty easy to figure out because that's all in the contract. But what about the discount rate? If it's private debt, how are you going to get the discount rate? Well, what do? They use borrowing rates currently available, so they're using current information for debt with similar terms and maturities. So if we maybe make our assumptions a little bit more sophisticated, we'll go ahead and use this number instead of the 795. So again, right now we're trying to get the target discount rate. So now, based on this information, can I calculate what percentage is debt and what percentage is equity? I can, right? So this just divided by that, and this divided by that gives me my various percentages. So now I've got the percentages. What else do I need to figure out the total weighted average cost of capital? Well, I need these various required returns, right? And of course, on an after-tax basis. So what I'll do is I'll begin with this required rate of return of equity, and a model in which you can estimate the required rate of return of equity is called the capital asset pricing model. Again, I'm not going to explain that now. You can look at the YouTube video if you want, the discount rate for financial securities. So because this is publicly traded, we're able to estimate, Yahoo Finance, for example, in September 2015, the equity of Meredith's beta. Now, what information do you think Yahoo needed to get that? Well, you'd have to know what beta means. So, for example, if the beta is 0.94, what that means is that when the market goes up by 1%, you'd expect Meredith to do what? Go up by 0.94%. In other words, an equity beta is sensitivity to market movements. So if you were going to estimate the equity beta, then what kind of information would you need? Well, presumably you'd need a proxy for the market, like say maybe the New York Stock Exchange Index, and you'd need Meredith's stock changes. So for example, maybe 100 days ago, when the New York Stock Exchange Index went up by 1%, maybe Meredith went up by 0.9%. And then the next day, maybe this happened, etc. So here we have 100 observations, and if we plotted them, maybe, and then fit a line most closely through this, maybe we'd find, hey, on average, when the market went up by 1%, that Meredith went up by 0.94%. And so therefore, the beta of Meredith would be estimated to be 0.94. And by the way, why do I say estimated? Well, I say estimated because when we look at this equation right here, the capital asset pricing model, in theory, is this about the now and the future? And what do I mean by the now and the future? Well, for example, if Apple were trading today for, say, $100, would that be based on expected cash flows in the future? So in other words, if Apple were trading for $100 today, would that be based on what investors hope to get in the future or what the previous guy got out of it? Well, when you buy stock, what do you care about? What you hope to get or what the previous guy got? What you hope to get, right? And so when I say, is beta about the now and the future, this is what I mean by the now. That's a stock price, and this is the future. And so do betas change, for example, on a second-by-second basis? Does risk change on a second-by-second basis, just like stock prices? It does, right? So in theory, this whole equation is about the now and the future, but what were we forced to do to estimate beta? Is there a ticker tape of betas that says, hey, right now the beta is this. A second later, this is the new beta? It's not, right? So a weakness, for example, in using this model is that you're forced to use historic data to estimate what it is. And by the way, there are other models that link required rates of return with risk, and they all have their strengths and weaknesses. So we were able to estimate this because Meredith was a public company, right? Yahoo was directly able to, for example, look at the market's returns over time and Meredith's publicly traded stock price changes over time. But what if Meredith had been a private firm? What do you do? Well, is Meredith in a specific industry? It is, right? It's in publishing and it's in broadcasting. So could you have looked at other publicly traded companies or industry or companies in the same industry? You could, right? And so we'll provide some more detail later on that and get more specific. But for example, here's a valuation handbook put out by Duff and Phelps, and they develop, for example, industry costs of capital, and there are other sources also. So now let's look at these other guys. Okay, what about the market risk premium? Again, in theory, is this about the now and the future? It is, right? In theory, it's about the now and the future. But guess what? Is there a ticker tape of, hey, you know what? Right now, the market risk premium is 10%, and now a second later, it's 9.8%. Is there a ticker tape that says, hey, this is the additional return required if you invested in a market portfolio? And there's not, right? So again, either you're forced to use historic data to estimate this. There's another way too that I'll bring up in a second. What about this though? What about the risk-free rates? If we're talking about a one-year T-bill, should we be talking about the spread of the one-year T-bill here? We should, right? Now, when it comes to both this guy, the T-bill rate, as well as the market risk premium, well, does the T-bill rate change depending upon whether we're applying this to valuing a public company or valuing a private company? It doesn't, right? It doesn't change. I mean, the T-bill rate is a T-bill rate. And what about this market risk premium? Do they go, hey, you know what? If I invest in the market portfolio, I require a premium of 8% above the risk-free rate, but only if you're doing public company valuation, and it's 7% only if you're doing private company valuation. Does that make sense? It doesn't, right? So in other words, this guy and this guy are independent of whether you're applying this to public company or private company. Okay? The only difference is this guy right here. It's a lot easier. We'll talk about this later. This is a lot easier to estimate if you're a public company because the information is directly available. So let's go ahead and look at estimating these guys. Like I said, for the market risk premium, you could use historic data. For example, Ibbotson, they go all the way back to 1926. And you could average that, or maybe you average the most recent 20 years, or whatever you believe best reflects an estimate of the now and the future for this market risk premium. Another approach is to survey people who use this stuff, survey managers and other experts, and they say, hey, for 2015, what are you using for a market risk premium? Fernandez, Pizarro and Asin, every year they come out with these estimates. So for example, in the US in 2015, they find that the difference is 5.5% using a T-bill rate of 2.4%. So if we just go ahead and use those numbers and we put all of this in, we would get a required rate of return of equity for Meredith of 7.6%. So let me ask you this. Could I apply the CAPM model to debt? In other words, if I had a beta of debt, could I, if I wanted to, apply the CAPM model? Well, presumably I could, right? Although in Meredith's case, do they have publicly traded debt? They don't. But if they did, I could estimate their beta and I could do all this. But is that really the best approach? So for example, suppose, I'll just make up some numbers. Suppose the target had one debt security and it was trading today for $100 and it was due to mature in 1 year, and the expectation was you'd get back 110 and that was the end. So the question is, does there exist a discount rate right here such that $100 is expected to grow into $110? And the answer is there is, right? I mean, that would be 10%. And that's the yield to maturity approach. So by the way, in calculating yield to maturity, what kind of data is it using? Is it using historic data? No. Is it using now and future data? It is, right? Here's the now, trading for $100 right now. And here's the future. By the way, would this amount change on a second-by-second basis, just like stock prices? It would, right? When bonds trade, they go up and down just like stock prices. And therefore, would this discount rate go up and down on a second-by-second basis? It would, right? So when it comes to estimating the required rate of return of debt, what would be better, to use the CAPM approach, which, if you recall, when we estimate it for beta, did we have to use historic data? We did, right? Or would it be better to use the yield to maturity approach, which counted on now and future data? Well, what's true in theory? Are we talking about now and future? Is this now and future stuff? Is that what is true in theory? So in other words, the weighted average cost of capital of the target, reflecting the discount rate inherent in the target or the riskiness inherent in the target, does that change on a second-by-second basis? It does, right? And does that change on a second-by-second basis as a reflection of the future in a direct sense? It does, right? And so therefore, if you have the choice between now and future data, which directly maps up with the theory of what you're trying to get, and historic data, which is a weakness, what do you use? Well, presumably now and future data, or in this example, yield to maturity. Well, if that's true, why not use yield to maturity for the required rate of return of equity? Do we have now data for equity? Do we know what stocks trade for if they're publicly traded right now? We do, right? But what about future data? I mean, with debt, can I look at a contract and see what I'm expected to get in the future? I can, right? But can we do that with equity? No. I mean, even if they pay dividends and you looked at the future, you could sell your stock, right? But do you know what your stock's going to be down the road? You don't, right? And so therefore, we're forced to rely on some model that links risk with return or required returns, and therefore the discount rate of the equity. So let me ask you this, does the yield to maturity approach rely on publicly traded debt? Well, what about this guy? Does this reflect what it's worth today? It does, right? And for us to know what it's worth today, does it need to be publicly traded, at least in this context? It does, right? And so the question is, in Meredith's case, they had all private debt, meaning banks, which is one source of private debt, were lending them money. So they didn't have they weren't available to see what is it worth today. And so here's all their various debt issues, which adds up to the $795,000. So if I were going to keep it simple, okay, imagine I'll take these three guys here, maturing 15, 16, and 17. Okay, imagine that this is all that they have, just to illustrate how you would calculate the overall required rate of return of debt. Imagine that as we saw earlier on, that the discount rates for these various debt levels were 3%, 2.5%, and 2%. And I'll talk about in a minute where you would get that from. Okay, but how could we calculate the overall required rate of return of the debt over here? Well, would a weighted average make sense? Presumably it would, right? And so I'll just go through the mechanics of figuring out a weighted average. Imagine these are semi-annual notes. These guys right here, are those required rates of return? They're not, right? These are coupon rates. And how would you know that? Well, it's about communication. It's about how a contract's communicated when it comes to debt issues. So you would have to go, and I'm sorry to keep doing this to you. I told you it'd be frustrating for you to look at this YouTube video unless you felt pretty good about some of the other finance stuff. So if you look at the valuation of stocks and bonds, it gets into this. That's another YouTube thing. But those are coupon rates. And then the next question is, well, how did they get the discount rates? Well, they looked at other securities, per their filing. Borrowing rates currently available for debt with similar terms and maturities. So Meredith is publicly traded for equity, but this is private debt, right? So whether the equity was publicly or privately traded, would this concept still apply for a private company? In other words, if I had a private company and they had private debt, would they have to be figuring this out just like Meredith did? They would, right? So if we look at the cash flows, for example, of the debt that's due in 2017, and I know this from valuation of stocks and bonds. Here are the coupon rates. That's 3.04 times 50,000, but it's semi-annual, so divided by 2. Then you get the principal back at maturity. If I apply a discount rate to this, okay, so this is communicated on an annualized basis, so a 6-month effective rate would be half of that, and I'd get a fair value of 50,395. So I could do that for the others, and essentially I'd get this much. And a weighted average of all of these guys gives me about 2.5%. A back of the envelope estimate might be the interest divided by the debt. And in any case, that is how you get required rates of return of debt. You'd have to take all of Meredith's debt, various debt issues, figure out their required rate of returns, and do a weighted average of them based on their fair values. So if we put it all together, so now we have the required rate of return of debt is 2.5% for Meredith, and the equity is 7.6%. What else do I need for this weighted average cost of capital? We already got the percentage debt, percentage equity, we've got these guys. I need the tax rate, right? And so according to their filing, the effective tax rate was 38.6%. And so you would basically come up with a discount rate of Meredith for 5.7%. So we're valuing Meredith. So we've got equity holders essentially looking at the riskiness inherent in Meredith, and we get this 5.7%. So what would I apply this to figure out Meredith's target enterprise value? Well, what two things do you need to value anything? Well, you need cash flows and a discount rate, right? And so if I now apply this 5.7% and I go back to some estimates I made of cash flows before, no growth after 250, etc., I would get about 4.4 billion. And so that would mean that the equity would be worth, on a standalone basis, 3.6 billion. So according to my estimates, hey, this is worth 3.6 billion, but Meredith accepted 2.4. Why the difference? Well, have we made a lot of assumptions? We have, right? So let's challenge some of those assumptions. And again, I'm just making up this challenge, right? I mean, you could be, or somebody who dives into the weeds of the accounting, and I know there's other stuff going on. So, for example, the year 2015, or the fiscal year 2015, Meredith had made an acquisition, right? Well, an acquisition is part of something that would be involved and treated similar to capital expenditures, right? It's a way of growing the firm. But then you have to be consistent with your growth assumptions. If your growth assumptions include inorganic growth, meaning acquisitions, then you would want to include it in the free cash flow estimates. If they don't, then they don't. Then you wouldn't. You'd want to be consistent. So like I said, I'm leaving out some of the nuances. I'm just trying to get across the big picture. But let's challenge one of our assumptions. One of the things that we thought that was odd earlier was we had a decrease in working capital. In other words, working capital went down, But with our assumptions, we're assuming growth, right? Growth or no growth. And yet working capital declining. In the context of the grocery store example, when the grocery store doubled in size, that was growth. Did we need more working capital or less working capital? We needed more, right? We had more shelves, so we therefore needed more inventory, and to buy the new inventory, would we need cash? We would, right? So that would have been a use of cash. So we have an assumption that didn't make sense. So just to illustrate, challenging, first of all, keeping track of any assumptions you make, and secondly, illustrating, throwing up red flags, when something doesn't make sense, and illustrating the importance. What if we just said, what if there'd been no change in working capital? Well, if there'd been no change in working capital, then this guy would have been about 180,000. So if we now make 180, and I'm just adding 5, just sort of randomly like I did before, and then assuming no growth, using the discount rate that we came up with, now we have this being about 3.3 billion. And so now we have a number of 2.5 billion. And so the standalone estimate is now 2.5 billion compared to the 2.4 that was paid. So we only made one change in assumptions, and we came to this number. And again, I'm not trying to make the numbers work. I'm really just trying to illustrate the importance of management with their information and what they have and their expertise and their ability to have confidence in estimating these future cash flows, or for that matter, their knowledge of not having confidence. And if you don't have confidence in these estimates, then you're going to place more decision-making power, if you will, on this kind of analysis, or less. Well, presumably less, right? Which is why we look at valuing these things in different ways, not just discounted cash flow. So this of course highlights the importance of doing sensitivity analysis and then questioning the assumptions. So what I want to do now is, well, when it came to this guy, what model did we need to estimate this guy? Well, we had the CAPM model, right? And when it comes to a private company, if Meredith had been private, in this whole CAPM model, what is the only variable that you cannot directly estimate? The equity beta, right? Why? Because, again, if we had the beta of Meredith being estimated as being 0.94, and what two pieces of information were necessary? Well, we needed the market and the stock price changes, right? But if Meredith is private, then we don't have that. And so how do we estimate what the equity beta would have been for Meredith if Meredith had been a private company? And that's what we're going to simulate right now. But to do that, hey, sorry about this, but now we're going to dive into stuff that I'm assuming that you have an understanding of, and that's levered and unlevered beta. And I'll tell you what it is just to give you a flavor, but to get more depth, you'll need to watch the YouTube video on levered and unlevered beta. So what we've already seen is that Meredith's beta, this is the symbol for Meredith, was estimated as 0.94, and we call that the equity beta. We also call it the levered beta, because when this regression was run, was it a secret, or did the market know that Meredith had debt? Well, they knew, right? And so just to emphasize this, we say, well, this is the levered beta, or the equity beta is the levered beta. So this considers two things, right? This considers, hey, I think I already have one here that I can use. This considers, the equity holders saying, hey, I have a required rate of return. what are you doing with my money, and how many folks get paid before me. Okay, so the 0.94 is just the regular equity, but we also call it the levered beta. So what's the unlevered beta? Well, what if, okay, I could somehow say, well, I wonder hypothetically what this number would have been if Meredith did not have any debt. Now, if Meredith did not have any debt, then would that make it more risky or less risky for the equity holders? Well, that would make it less risky, right? Because would anybody get paid before them? Or any investors get paid before them? They wouldn't, right? In which case, this, what we call unlevered beta, I wonder hypothetically what this number would have been as if Meredith had no debt. Would we expect this number to be bigger, reflecting more risk, or smaller, reflecting less risk? Well, presumably smaller, right? And so I just made up this number, 0.8. And so that's what I mean by unlevered equity beta. You know, what the beta would have been hypothetically as if Meredith had no debt. And so we can derive a formula between the unlevered beta and the levered beta, okay, based on some assumptions, and this is where you can find it, you know, how we derive that, etc. So I would encourage you to look at that. And so I'm going to use this formula when we look at, well, how can we estimate Meredith's equity beta, hypothetically speaking, if it had been a private company. So the first thing to get across is, okay, here's the regular equity or levered beta. So in the case of Meredith, this was 0.94, right? If we then say, well, I wonder what it would have been as if there'd been no debt. And with the number I made up, it was 0.8. Then with no debt, if this is basically nothing here going on, would the 0.8 reflecting the unlevered beta, would what's on this side match or mirror what's on that side? In other words, should the riskiness of what's going on over here equal the riskiness of what's going on over there? Or is it a balance sheet? So should these two sides balance in terms of risk and dollars, etc., etc.? They should, right? And so therefore, the unlevered beta, which means, you know, we take the 0.94 using Meredith's numbers, and if you say, I wonder what that would have been as if there were no debt, and that goes down to 0.8, well, that would reflect the overall risk on this side, because it's hypothetically saying, you know, if there's no debt, then all that's left is the unlevered, which mirrors this guy, and so therefore, the unlevered beta mirrors the operations or the assets, the riskiness inherent in the assets. So what we'll do is we'll use that to estimate a private company's required rate of return of equity. So the first thing to note is that, all right, Meredith, they happen to be in two business segments. If you go to the website bar chart, they're in publishing and broadcasting, according to bar chart. And according to bar chart, at least the publishing under this SIC code, they find two publicly traded companies. In other words, if we're going to pretend Meredith is a privately traded company, we're actually going to use public company information to estimate the business or unlevered beta of Meredith. And so two companies that happen to be in this segment are Martha Stewart and AMREP. And so what are we going to do? Well, we're going to take these two companies and we're going to figure out what their unlevered betas are. And then we're going to average them. And we're going to say, all right, well, the average beta of companies in publishing is the average of these two companies. And we'll say, well, that therefore is Meredith's unlevered beta. And then once we have Meredith's unlevered beta, then we'll re-lever it according to Meredith's debt and equity ratio. And then we'll put that in the weighted average cost of capital formula. So in other words, we're going to use public company information that's out there representing industry business risk. So we're going to back out anything to do with the financial risk. Okay, we're going to get this business risk. We're going to average that and then apply that to the existing capital structure of Meredith. In other words, relever the average unlevered beta. So we'll begin with the Martha Stewart one. Turns out Martha Stewart has no debt. And the estimate of their regular equity beta, assuming debt, was 1.13. Well, if Martha Stewart has no debt, then would the levered beta be the same as the unlevered beta? It would, right? Because it already is unlevered. The regular equity beta already is already reflecting strictly, hey, what are you doing with my money? The riskiness inherent in the assets. So that's an estimate for Martha Stewart's unlevered beta. Now let's look at the other company, AMREP. Okay, well they have this much debt and this much equity. These are market values, of course. An estimate of their regular levered equity beta, because they're publicly traded, so you can estimate it as this much. And if you plug in the various numbers to estimate the unlevered beta, you get 0.89. So what we're doing is we're saying, all right, well, for this particular industry, the publishing industry, we've got AMREP representing 0.89 with their risk, Martha Stewart representing 1.01 with their risk. Okay, I'm sorry, 1.13. So we've got 0.89 for AMREP, 1.13 for Martha Stewart. So if we average it, we average these two numbers, we get 1.01. By the way, are you comfortable with that estimate? So if I were going to draw it, I would say, all right, so we've got Martha Stewart with 1.13, and we've got AMREP of 0.89, and if we average, we've got 1.01. Okay, so are you comfortable? Well, it's a matter of judgment, right? I mean, they are about 0.2 apart, and you might say, all right, well, yeah, that's not bad. That's pretty close. But what if one had been 0.5 and the other had been 1.5, and the average was 1? Well, now they're a whole 1 apart, right? And you might be thinking, hey, this is garbage in, garbage out. So in any case, so now we're just going to assume that the average business risk for Meredith is 1.01. We're now going to relever it according to Meredith's debt equity values. So we're going to put in the 1.01 here. We've got debt equity ratios. We're going to say, well, now what's the levered equity beta? In other words, what should this number be now, considering that folks get paid before me? So would you expect the beta to be bigger or smaller than 1.01? So we're estimating this as Meredith's beta as if nobody got paid first. To then turn it back into, well, hey, we do have debt, so people do get paid first. Would it be riskier or less risky for the equity holders? Be riskier, right? So would the number be bigger or smaller? It would be bigger, right? And so if we plugged in the numbers, we get 1.29. So if Meredith had been a private company, we would have, if we'd used these numbers, we would have said 1.29. But guess what? Because they were publicly traded, we were able to directly infer what they were, and Yahoo said 0.94. Does that seem like it's off by quite a bit? Again, it's a matter of judgment. Some might say yeah, and so then you'd think through, why? Well, let's look at Meredith's assets, right? Meredith is in both publishing and broadcasting. Did we just do an analysis of the unlevered beta for publishing? We did, right? And so maybe publishing is a lot riskier. I mean, if you think about it, print relative to broadcasting, I mean, what would you say is riskier? Would you say publishing is becoming increasingly either obsolescent with your typical print or subject to technological innovation and competition, et cetera, et cetera? And if that's the case, if this is higher risk, then maybe it makes sense that you'd expect a number that was higher. And guess what? There are ways where we could infer what the broadcasting risk is, and we could do a weighted average, and we could get more sophisticated. But the bottom line is that for us to estimate this equity beta for the private company, are we going to have to use publicly available information that's out there? We are. And then are we going to have to assess whether it's garbage in, garbage out? We are, right? And the more, even if it's not garbage in, garbage out, does it still highlight the importance of complementing this type of analysis with other valuation approaches? It does, right? And what are some of those other valuation methods? Well, for example, and this is used all the time, whether it's private or public company, trading and transaction multiples. It's again, you're triangulating. You're using different estimates to get a sense of what is and what is not reasonable. So there's various databases that provide current trading multiples, for example, Modern Distribution Management. Another example is the New York Stern School, January 2015. By industry, enterprise value divided by EBITDA. Okay, broadcasting, publishing. If we just do a back of the envelope calculation for Meredith, which is in both of these, if we just assume 10, well, Meredith's most recent EBITDA was 300 million. Okay, so if we assume 10 times, well, that comes to 3 billion. If we compare that to our discounted cash flow, we ended up with 3.3 billion. Does that seem like it's in the ballpark or not in the ballpark? Well, it probably does, right? But again, you shouldn't place a lot of emphasis on what I happen to come up with this 3.3 billion, because I just made up the assumptions. I'm not part of Meredith's management who may or may not have a good sense of what to expect with the industries, and et cetera, et cetera. So what we've done at this point is we've basically, the goal has been to set some themes with mergers and acquisitions valuation, and then we got into the weeds of valuing these things on a discounted cash flow basis, and then we've backed this up with a much, much easier approach with trading multiples. And if I were going to summarize some significant takeaways, basically, do you have one set of financial principles for private companies and another set for public? You don't, right? It just doesn't make sense to say, hey, you know what? I require more risk for more return, but only if I'm a public company or only if I'm a private company. The foundations of finance when it comes to valuation are presumably going to apply to both. Then we looked at intrinsic value or true value. Well, according to Warren Buffett, this involves the discounted cash flow approach. And what two things do you need to value anything with the discounted cash flow approach? Cash flows and a discount rate. But as much as we'd love to have this true value, is it observable? No. And guess what? It not only is it unobservable for private companies, it's also unobservable for public companies. For public companies, we can observe the market value, but the market value is based on what level of information? Just public or public and private? Just public, right? So even a publicly traded company, if you're Meredith and you're a public target, management would maybe have a sense of, you know what, we're being undervalued by the market, or we're being overvalued by the market. So if we do this, if we apply this discounted cash flow approach, what about the cash flows? When it comes to forecasting, is there any difference in principle for private versus public companies? There's not, right? You know, private company's going to have to forecast, so is a public company. And in both cases, you know, you're going to have assumptions. You know, one approach, as I suggested earlier, is, you know, with my friend who's done a lot of these deals, is to, number one, identify the key assumptions, and number two, hold those who are in the most control of those assumptions accountable. You know, carrot and stick approach. For the discount rate, if you're a public company, the one area, one area in which you have an advantage of being able to, you know, estimate your value is you can estimate your beta in a direct sense. But if you're a public company, your equity beta, you're going to have to use a industry approach. Hey, I'm in the publishing industry, so I can look at other publicly traded publishing companies and estimate my betas. And in both cases, whether you're publicly traded or not publicly traded, well, you know, you definitely, absolutely want to back this up with other valuation approaches, because this intrinsic or this true value is unobservable, and either highlight a red flag, hey, you're way off base. There's no way your terminal value can be that high given the multiples. Or maybe, you know what, this makes sense, you're on base. And so other valuation approaches are going to be very important, whether you're publicly traded or privately traded. So that's a ton of material that we've covered. And if you've made it all the way through the end, my guess is that you've already have a pretty good understanding of financial principles, either from somewhere else or you've looked at my corporate finance lecture series. And in any case, I hope this has been useful to you. And I will see you at another video maybe. Take care.